It is almost 11 a.m. in Hong Kong and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Here are the top stories. Asian stocks trade higher as focus shifts to company earnings, with some of the biggest names in global tech set to report this week. Emerging market bonds losing their shine with investors due to the strong dollar and rising treasury yields. Middle East tensions are also adding to the pain for EMs. Also ahead, a little-known Singapore telehealth company becomes the hottest U.S. IPO this year, with gains of more than 500% since listing this month. We hear from its co-CEO. Another great guest on the show. First up, Silverdale Bond Fund CIO Sanjay Guglani with his outlook for emerging markets. Later, we have the CEO of the world's second largest zinc miner and third largest silver producer, and we're talking about Hindustan Zinc. Well, let's do a check-in and see how markets are faring. Avril Hong is in the Lion City. Avril, what's the latest?
Well, we're seeing those Asian stocks staging a rebound along with U.S. futures today, Haas, and this is perhaps that relief that Iran isn't escalating further after that retaliatory strike from Israel last Friday. We are seeing the focus shifting back to the fundamentals, corporate earnings and U.S. data due this week, including on growth as well as the Fed's preferred gauge of inflation. Now, for now, we're seeing the Hang Seng leading the charge 2% higher. We're also seeing the Nikkei bouncing back today, in break today, of course, in Japan. But we're seeing bonds under pressure. Now, amid all this, the BOJ is set to hold rates on Friday. But given how the weak yen seems to be affecting the outlook for inflation, there are some that are bracing for the Japanese central bank to perhaps start announcing quantitative tightening. Now, we're also seeing among asset classes, the stocks in the chips as well as the tech sector. Those are really the ones that are bearing the brunt of the selling. Infotech is down today, sliding, extending those declines from last Friday. Let's flip the board and take a look at some of the movers. And this is against the backdrop of Nvidia that tumbled 10% last Friday. That was the steepest drop in 4 years. So it really begs the question whether they will live up to these high expectations regarding the AI theme, Haas.
The fact that it is still among the best performers year to date. Avril Hong, thank you. And markets will be focused on U.S. big tech earnings this week. Tesla, Microsoft, Meta, and Alphabet are due. Here's what some of our guests have been saying about those earnings.
We're hearing it's all big tech, right? That's what some of the headlines are this quarter is about big tech.
Big tech has great balance sheets with a lot of cash and very little debt.
Mega cap tech companies that are generating extraordinary amounts of cash flow, they're still actually doing very well.
Tech is a big part of the quality story.
And we still would expect for this quarter in particular for many of those companies to lead on earnings growth.
You look going out, 1, 2, 3 quarters. I mean, it is going to start broadening out.
You can't have tech be the only thing that does well if you're starting to see economic weakness in other places.
We're just ramping up earnings season now, and I think that's going to be a good distraction for the market to be able to sort of have a look what's actually going on to see whether the lofty valuations are actually supported by the fundamentals.
Big tech, big expectations. Let's get analysis with our MLive strategist, Mark Cranfield in Singapore. Mark, active markets looking to big tech and Mag 7 for an earnings boost this week. Well, you know what? Enough to bring some cheer this Monday morning.
Well, the Pulse survey focused very much on the risks coming from Treasury yields maybe reaching 5% as the biggest factor, which may weigh on earnings in the earnings season that's coming ahead here. They were slightly less worried about the AI impacts, that companies wouldn't come through on these wonderful promises of where AI was going in terms of what it means for earnings. But of course, most of the Pulse survey was done before Nvidia dropped 10%. And so as we go into this period where most of the Magnificent Seven is reporting this week, Nvidia itself is reporting later in the month, but people will be very concerned, especially as that particular stock has become the favorite of the retail crowd. It used to be Tesla, but it's now switched to Nvidia. The turnover is very much dominated on a day-to-day basis by what retail punters are doing. And the investing crowd particularly the institutional guys, should be pretty wary of this because they've seen what's happened when the retail crowd turn against the stock. Tesla's had a very bad, of course, the relative news coming out of Tesla is not so great, but the retail crowd have turned their backs on Tesla. It's one of the worst performing among the major companies. So NVIDIA really needs to fulfill a lot of promise for the whole sector, not just for itself. Otherwise, if retail investors turn against it, it could be very bad for the broader market.
That's right. Earnings, one issue. The other is the yields, whether it'll get to 5%. The Fed weighing on risk assets like big tech. How is this going to play out with more, I guess, key U.S. economic data coming this week? PCE, case in point.
Yeah, again, our economists within Bloomberg, they expect the numbers to tick up slightly, which will be a slight problem for the Fed, because if you look back to December, they were really putting a lot of weight on the fact that that PCE number, particularly on an annualized basis, was going to come in below 2% and was going to give them the reason for starting on lowering interest rates. That's not happening, of course. There were a couple of disappointing CPI reports as well. So if they get another one that comes into the mix, really people will have to think very seriously about, even do we see any rate cuts in the third quarter? Are we talking more about the fourth quarter? So those Fed speakers that have been saying they only see one cut this year are starting to look like the bright guys in the room here. So all of that is really putting more weight on where the next dot plots are going to be. By the time they get to June, it looks as though it's going to be very difficult for the Fed to maintain an outlook where there are 3 interest rate cuts this year. Time will have just run out unless we get some very soft data between now and then. And don't forget, we've also got a lot of Treasury issuance this week as well. So the bond market is going to be extra volatile just because it has to absorb an awful lot of issuance on top of what the expectations are in terms of this PCE data.
Mark Cranfield, MLive Strategist, we thank you so much for your insights today. Now, U.S. growth and the Fed's preferred measure of inflation, the PCE, as we've been talking about, are due this week, which will help finesse bets on the timing of rate cuts. Our next guest believes now that we've hit peak borrowing costs, bonds are attractive with high carry. Let's bring in Sanjay Guglani, who manages over $1 billion as founder and CIO of Silverdale Bond Funds. Sanjay, good to have you with us. I mean, where are you putting your money right now?
We still see a lot of value in the 3 to 5 year duration bracket. We see even if there were no further rate cuts, it gives a fantastic carry. And God forbid, even if there is no rate cut or even 2 rate hikes, it still gives you a positive return for the next 12 months.
What makes you think we've reached peak rates?
2 things. First and foremost, if you look in terms of the real interest rate, they're close to about 2%. And a real interest rate about 2% is rarely sustainable. The other thing is look in terms of the broad prospects of the economy itself. The economy is very robust, no doubt about it. But if you look in terms of the various parameters underneath, I think we are already seeing certain cracks in the economy. For example, we all talk about the US consumers being robust, and they are indeed. We're talking about for example, mortgage cost to be about 3.8% on an average, when the current prevailing is about 7%. But what people tend to overlook is if you look in terms of, for example, the delinquencies in credit cards and auto loans, we are already above the pandemic. But the key point to notice is when you talk about the bottom quartile, we are close to almost 2008. Likewise, if you look in terms of corporate bankruptcies in 2023, they were almost equal to the previous 2 years taken together. I agree. In terms of quantum, they are nowhere near the average. But the bottom of the pyramid is indeed getting crushed. So from that point of view, we don't see a very strong reason for the Fed to go for further rate hikes, barring, of course, accidents. We can never know what happens in the world scenario.
Sanjay, we saw 2-year yields breaching 5%, now just below that level. What would it take for 10-year yields to get to 5%? And might we see that?
Look this way, in broad, rather than focusing on key data points from the investor point of view, it would be way much better to focus on the big picture. So the way I would put across is rather than focusing on trees, look at the forest point of view, right? So from a big point of view, you're already talking about bond total returns to be one of the highest we have seen in multiple decades. In terms of exact point, in terms of what will take 10 years to reach there, of course, this key point will be in terms of inflation. But look, from inflation point of view, the key problem there is in terms of sticky service inflation, and in that the key point is in terms of the shelter CPI, and 44% of the headline CPI comes from shelter CPI, and shelter CPI lags the rental between 9 to 15 months. We already know rents have come down, so shelter CPI would come down. Now comes the tricky portion, which is that we are not seeing any further reduction in rentals for quite some time, and that could give a certain amount of cushion in terms of where it comes down. But yes, in the immediate term, barring certain, for example, flare-up in the geopolitics sector out there, we think the inflation is still on the downward trend.
Sanjay, there's so much conviction that you should be putting your money to work right now, yet we have trillions of dollars sitting on the sidelines. When do you see that mobilized, and how might this play out in the market?
So 2 points. So if you look in terms of absolutely short-term point of view, so we already seen money flowing into fixed income from now 17 continuous month on totality basis. And in specific, we have already seen money moving from, for example, into money market mutual funds and from equities into fixed income. I agree. They are still pointers. They are not a tsunami coming across out there. But we are already seeing certain rotation where we see, for example, from the even technology shock point of view, we are seeing very actively people are moving away from that and, among others, into fixed income. So what we are seeing there is very interesting, which is this. While the headline numbers don't look very dramatic, but if you peel the surface, you will notice very clear trends in terms of the fact that the money is going into locking in for long term, specifically as we see from in the cases of insurance company and pension funds. In particular, we are seeing people being willing to lock in the monies for medium to long term, which is something which we didn't see for almost a decade.
Sanjay, what is the biggest risk to your base case right now?
See, in terms of the risk, I would define the risk will be two. One is a known risk, and the known risk is the lag effect of monetary policy. The sort of hike which we had, it is going to crack the economy. We're already seeing cracks in the bottom of the pyramid, so those are in fact going to come. So we do know it's going to come. We just do not know how fast and how much it will be there. So that's something, a known risk. The unknown risk, of course, is, for example, in terms of geopolitics, which could be completely out of the control. Geopolitics, by definition, is a very naughty creature. It's very difficult to predict how it's going to happen. But yes, something which you need to be careful about.
Not to mention that markets have been totally wrong when it comes to Fed rate path this year. Sanjay, hang tight. Sanjay Guglani, Silverdale Bond Funds is sticking around. Well, still to come, startup Mobile Health Network Solutions has become this year's hottest U.S. IPO. We speak with their co-chief executive later this hour. Plus, we'll also be joined by Hindustan Zinc's CEO to discuss the company's latest earnings. But first, the IMF is warning of a severe oil shock if tensions in the Middle East further escalate. Our interview with First Managing Director Geeta Gopinath is up next. Keep it here with us. This is Bloomberg. Welcome back. The IMF's first Deputy Managing Director says the potential for oil price shocks from escalating tensions in the Middle East would be problematic for the global economy. Geeta Gopinath also discussed the outlook for U.S. interest rates at the IMF spring meetings.
This is a risk we worry about. If there is a serious escalation, which means a much more wider regional escalation than what we've seen so far, then yes, we could have a severe oil shock. But we're not there yet, and as you can see in terms of oil prices, it went up some, but it's come back down. We have excess capacity in Saudi Arabia. We have non-OPEC countries putting a lot more oil out on the market. So there are other sources of supply that can, buffer these shocks. But if there's a large-scale escalation in the Middle East, that is a problem.
Is that the line in the sand, $100 a barrel, and that would consist of the shock?
I think going up $100 a barrel would be problematic, but even going from here to $100 a barrel would be difficult for countries to deal with, who are still fighting the last inflation fight, which is to bring inflation back down to target.
One thing that the IMF has talked extensively about is concern about sovereign debt, in particular in the United States and the overhang there. What's the outcome of that? Is the fear of some sort of slugflation or just sort of a sluggish growth kind of picture because of the overhang? Is it higher rates and potentially a Liz Truss moment, which I've been talking about and get shocked at all the time in the U.S., but is there something like that that could potentially happen?
The U.S. is running very large deficits for a country where demand is very strong, and there is still the last mile in terms of bringing inflation down. So for all those reasons, the deficit, you can't have a deficit of 7% of GDP. It needs to be lower. And if you project out, it's going to stay at those high levels for a while. That has consequences, of course, for debt servicing in the U.S. But in a sense, the bigger problem is in terms of spillovers to the rest of the world. Because for the rest of the world, when you have so much of debt being issued by the U.S., that can crowd out the borrowing from other countries. Their cost of borrowing goes up, and their debt servicing costs go up by much more. So, I wouldn't say the U.S. has a debt sustainability problem now, but at the same time, when the U.S. is borrowing that heavily, that causes rates to be that much higher. It has implications for the rest of the world and for corporations and households in the U.S.
How much higher? I mean, could you see rates staying here between 525 and 550 for the rest of this year, for even into next year?
That would not be our baseline. We would expect to see rates coming down. So right now it's for getting inflation back to target. So we expect that will come down. It's going to take a little longer, but we expect that to come down. The question is whether it comes back down to what we saw in the decade after the GFC. And there, right now, that doesn't seem to be the case.
And that was IMF First Deputy Managing Director Geeta Gopinath speaking with our very own Lisa Abramovich. Let's bring back our guest, Sanjay Guglani, who manages over $1 billion as founder and CIO of Silverdale Bond Fund. Sanjay, we heard from Geeta. It is problematic. We have higher oil, higher dollar, higher yields. It is in particular problematic for emerging markets. How are you doing? What are you doing with emerging markets?
Depends on which emerging market you're talking about. So in terms of Asian emerging markets, for example, in terms of India, Pakistan, Sri Lanka, etc., they're net importers of oil. Of course, they get impacted adversely. While if you look in terms of Brazil and other countries which actually produce oil, they stand to gain marginally. So from the big picture point of view, from the oil specific point of view, we have to see each emerging market differently. The other thing to keep in mind is in terms of the fact that the US interest rate cuts expectation have dropped almost from 6+ in the beginning of the year to now we're talking about 3-, like about 2-ish or there. So to that extent, the emerging market currencies are having a basic of hit. And that is the reason why we at Silverdale prefer to look in terms of hard currency debt from the emerging markets, which gives you the extra bit of extra pickup without the currency risk.
Sanjay, let's delve deeper into the Indian market. Investors seem to be losing some love when it comes to Indian debt, despite pumping in $9.5 billion on the back of expectations of that inclusion in the bond index. How do you play India right now?
See, India is very interesting because of two very important reasons. Number one is from the fundamental point of view, the stars are aligned for India. They are doing a fantastic job in terms of investing for the future. For example, in terms of creating the necessary infrastructure and ecosystem, which will ensure the India grows at a considerable pace. It is indeed one of the fastest growing large economies in the world. And by definition, a large economy means there are more opportunities which comes in the debt market too. Yes, today we're talking about from the currency hedged basis, India doesn't look as attractive. But talking from the long-term point of view, Indian rupee definitely provides a huge diversification benefit. Even from the hard currency point of view, there are numerous Indian high-yield names which looks very attractive in the current scenario, and all such events like geopolitical events, etc., out there provide an additional opportunity to pick up those names.
You've been an early mover in India. I'm just wondering whether you're unwinding some of that positions right now.
Not really. So we can't talk about exact positions, but let me put this around. We are hardcore bottoms-up investors. So when we see the volatility in the market increasing, we are always there to swing and make certain bucks there. So the key point is twin. Number one, if you're talking about Indian IG, yes, Indian IG is indeed very tight, and we have lightened a bit of a position there. But in terms of Indian high yield, I think it still gives you a certain amount of value.
Sanjay, before we let you go, it's hard to talk about India without bringing China in comparison. Are there opportunities in China?
Yes, so it's very interesting when people talk about China not growing. Let me remind people that, look, we are still talking about China growing at 5.3% for the second largest economy in the world, which growing at that pace is not a joke. It's a wonderful thing to happen, specifically when you contrast it, for example, with the Eurozone and other countries. So the key point is this, people are overtly focused in terms of the property sector in China, and for the right reasons. It is indeed into shambles, and it does impact almost 20-25% of GDP. But if you look in terms of the actual breakup of the where the China growth is coming from, it's coming, for example, from the tourism. It's coming, for example, from the EVs, from the electrical machineries, from resources. Right. I'll give one number to give an example to you. So if you look in terms of what the Chinese government has done in terms of helping people to buy the various machinery sector out there, they invested almost 5 trillion yuans in that, right? Combined with the 5-6 trillion, it becomes almost 1.5 trillion,
Sanjay,
which is equal to investment in the property. So wonderful opportunities there.
Sanjay, we have to leave it there. Sanjay Gulani, Silverdale Bond Funds, thank you so much for being with us today. Plenty more ahead. Keep it here with us. This is Bloomberg. Well, China shares in the money this Monday. We're keeping a close watch on China Big Tech, in particular on the back of Tencent. Well, planning a new game, and it's called Dungeon and Fighter Mobile, and that's due in China on May 21st, according to Nexon. It said that in a statement. The game, originally released in 2022, is expected to give Tencent a boost with its China debut. Take a look at that. Tencent surging more than 4% gains too for Meituan, JD.com, as well as Sunny Optical, currently up by almost 3%. Well, still ahead, our exclusive interview with the co-chief executive of Singaporean telehealth startup. We're talking about mobile health network solutions. Hear what's next for the company after a very successful U.S. listing. Keep it here with us. This is Bloomberg. There you have it, live from Shanghai. Welcome back. China markets just heading to lunch. CSI 300 index reversing gains for the day, now in losses, down about 0.3%. Just to recap what the banks did, they kept their 1- and 5-year LPR unchanged, tracking the PBOC's decision last week, of course, increasing pressure on the Chinese yuan amid Fed's higher for longer. There's now limited scope for the PBOC to lower rates. CSI 300 index down, Shanghai Com also lower by 0.5% right now. In terms of the yuan, 724.29. Flat versus the USD, and of course that fix was pretty steady by the PBOC as well. Now, China headed to lunch, Japan back from lunch, as we check in on how Japan is doing. Avril with the very latest.
Yeah, Has, today we've been seeing Japan part of that relief rally across the Asia-Pacific, that sense of perhaps relief coming through because there isn't further escalation given the Middle East tensions from last Friday. The Nikkei coming back from the lunch break, pairing some of the gains from the morning session, but still has to be said it is a rebound. A rebound, though, that is still about 9% lower from what we saw in the peak in March, and that was post-BOJ rate hike for the first time in 17 years. We are, of course, on the lookout for the BOJ at the end of the week. Friday is when it's set to hold on rates, leaving it unchanged. But given how the weak yen and that tick up in oil prices could be affecting the inflation outlook, there are some pockets of the market that think that the BOJ could announce the start of quantitative tightening, and it could do this through the reduction of bond purchases. We're seeing bonds coming under pressure today. Now let's flip the board, because also in Japan, what we are watching out for are those automakers. We had Nissan missing on the annual profit forecast as the sales came in weaker. Honda is said to be on the cusp of a deal with Canada, a multi-billion-dollar pact that could see the automaker making vehicles and components in Ontario province. And this comes at a time where the EV industry is really at a crossroads, right? Where we're seeing perhaps some slow consumer uptake because of the high prices, because of the lack of charging points. But it seems like they are making these bets for the long term, Has.
Errol Hong, thank you. Let's stay with EVs. Tesla's move to slash prices across its range in China risks triggering a new round in bruising price war. Li Auto immediately responding with discounts and cash rebates on new models. Its stock is taking a beating in trade today. Tesla CEO Elon Musk, meanwhile, has also decided to postpone his trip to India, blaming the delay on pressing issues at the company, which spent the weekend cutting prices for its cars as well as driver assistance software. Musk's visit was supposed to include a meeting with Prime Minister Narendra Modi and a potential announcement on his investment plans for the country. Let's get more, dig deeper. Let's bring in Bloomberg's PR Sanjay in Mumbai. And Sanjay, of course, what a bummer, right? Because that visit was meant to perhaps, bring some new investments. There was so much excitement prior to that.
This is not the first time. In fact, he was also promised to visit during Vibrant Gujarat, one of the brilliant, most known, famous investment platform, which happened in Gujarat earlier this year, where he has promised that he will be coming, but he didn't turn up. So this is the second time where he's promised and he's not able to make it. And during this visit, he has big plans to meet Prime Minister, and he has also plans to announce certain thing like about Tesla opening showrooms, and also we were expecting that there could be some announcements for Starlink, which can be potentially a competitor or rival for Mukesh Ambani's Reliance Jio Infocom, as well as Bharti Airtel, the number 2 telecom operator, wireless operator in the country. So he said due to heavy obligations, Tesla obligations, he was cancelling, but it is not actually cancellation, it is a postponement. He has promised that it will be coming later this year. The new dates have been known, it will be known, and we will keep you posted about that.
Of course you will. On top of the story, always, Sanjay, you got to wonder what difference Elon Musk and Tesla would make in the EV scene in India.
Oh, it's an interesting question. So, as you rightly pointed out, Tesla is cutting prices because it's facing stiff competition across the world. So, after US, he has to cut prices in China and Germany, which would mean which is the next big market. And as yesterday, the Indian Finance Minister Nirmala Sitharaman pointed out that India, the policy is right, and since there are concerns, shown by other global majors in the China market, India is a natural destination. So, she was hoping that Elon Musk could make some big entry into Indian market, and because India's the policies are right, and states like Gujarat, Maharashtra and Tamil Nadu have said they are offered a huge land parcels, talent pool, etc., to invite Tesla. And for Tesla, India will be a great market. It is world populous country, which is now having its largest general elections too. So they feel in government feel that India is a right market for Tesla, and Tesla could make some difference. Though there are various other school of thought that Tesla could not be affordable for a market like India. But for India, this will be a big win if Tesla comes to the country and announce a plant. That would be big boon for the Prime Minister Narendra Modi, who is contesting elections and was vying for the third term in the country.
Bloomberg expert Sanjay Mumbai with the very latest on the EV scene in India, as well as that delayed visit of Elon Musk to India. Now, for a deep dive into the turmoil at Tesla right now, users can read today's Big Take. You can find that story on the terminal at NI Big Take or on Bloomberg.com. Now, here's one stock to keep an eye on. Mobile Health Network Solutions is a Singapore telehealth startup that went public on the Nasdaq less than 2 weeks ago, and is now the year's hottest U.S. IPO. The stock's up almost 600% from the offer price of $4 per share. For more on its expansion strategy, we're joined exclusively by Co-Chief Executive Rachel Teo, who's a doctor in charge of medical diagnosis and treatment. Rachel, good to have you with us. 600% upside. I mean, can the company really justify that kind of upside in its debut?
Hi, thanks for inviting me. Of course, I'm extremely pleased with the strong market validation and the endorsement. I mean, I'm not surprised with this strong endorsement. As you can see, ManaDoc, or Mobile Health Network Solutions, provide an all-in-one platform. Not only that, we provide all-in-one affordable care, which is not only AI-driven, that's truly humanized, and they connect to user intuitively. So if you ask me whether I'm surprised, no, I'm not. And we will continue to work hard to build this.
So how do you build investor value from here? I mean, what's the growth plan?
Thanks for the question. Okay, 45% of the net proceeds will go to our development of AI Health Companion. We will also be investing in our health operating system to ensure that our doctors have access to robust system, which is industry-specific platform. We will also be looking at geographical expansion within the APAC region. And 30% of the proceeds will go to strategic mergers and acquisitions.
Rachel, we know that you tapped a small unknown brokerage called Network One for your IPO. And we know that this brokerage has done other boom and bust IPOs, the likes of GameStop, for instance. I'm just wondering, are you concerned that your company could suffer the same fate?
We have actually looked at a few US firms before look at Network One Financial. We are extremely pleased with their performance, and they are so far most responsive and professional in handling this. And we have received very strong market validation on this. I'm sure a fair market will actually recognize what we are doing and the value proposition that we bring to the table.
So you're confident that Mobile Health Network Solutions will overcome those kind of concerns?
We have consulted our legal counsel. We work very closely, Raja and Tan and Sidley. So we are very happy with Network One's responsiveness and also professionalism.
Any plans for a dual listing in Singapore, for instance? It is, after all, a Singapore company.
We are listed in Nasdaq less than 2 weeks. We are 100% focused on Nasdaq. So at the moment, we do not have concrete plan on that, as we are actually very focused on building our business.
But on a longer-term plan, in terms of longer-term strategy, could a dual listing work for you?
Well, looking at the current situation, we are expanding regionally. We are able to do what we want. So we are 100% focused on Nasdaq at the moment.
Talk to us about your expansion plans in the region, which includes the likes of Australia, for instance. I mean, are you planning to add headcount to these markets?
So we are looking at expanding regional, especially Vietnam, Indonesia, and Malaysia. These few countries have a combined population of half a billion of population. And not only that, they have one of the fastest growing economies in APEC region or maybe in the world. And they also have a relatively younger population who are more receptive to our innovative healthcare solution. So these are the few countries we are looking at the moment. And talking about expanding regional, we are also, yes?
Go ahead, Rachel.
We are also very mindful to the local regulatory framework. So Dr. Sell and I, myself, are very experienced doctor. Dr. Sell, he actually sits in the telemedicine guideline drafting committee, and I have more than 20 years of experience. So we will be guiding our doctors to uphold the standard of care.
Rachel, one final question
in expanding
before we let
the
you
region.
go.
Sorry, I can't really hear you.
Just one final question. In terms of profitability, when might that happen?
Okay. At the moment, we are actually looking at expansion. And the price that we are actually quoting at the moment is actually very affordable. We are talking about, in Singapore dollar, about $8, ranging from $8 to $25. So at the moment, we are looking at expansion and increase the user growth. So even if we increase the price by another $2 or $3, we actually turn profitable anytime. But that is not the part that we are working on at the moment, because we are currently focused on building our platform, our health operating system, and also working on an AI health companion. So if you ask me, when do I want to turn the company profitable? Okay, it can be done at any point of time, but at the moment, we still want to make sure that we provide value to our users and patients. We want to ensure that we build a strong foundation for the company and enhance the capabilities before we talk about profitability, but it will come soon.
Rachel, thank you so much for your time today. Rachel Teo, Mobile Health Network Solutions. And of course, earlier I talked about Network One, the IPOs that it has done. I stand corrected. It is not GameStop. It includes the likes of Laser Photonics at this point in time, among other 20 companies that has gone IPO. Well, still to come. Hindustan Zinc posts a 21% drop in fourth quarter net income. The CEO joins us with the outlook next. Keep it here with us. This is Bloomberg. Welcome back. You're watching India Focus. Hindustan Zinc is the world's second largest integrated zinc producer and the third largest silver producer. The unit of Vedanta Group reported 21% drop in net income for the fourth quarter, with revenue falling 12% on year. Let's discuss this and more with CEO Arun Misra. Arun, good to have you with us. 20% drop, and that's due to zinc prices. What assumptions are you making about zinc prices in the coming quarters?
Thank you for joining. And zinc prices going up. I think we have already moved up from $2,400 to about $2,850 a ton. My guess earlier was that we would be touching $3,000 a ton by the end of December, but looks like by August, September, we should be breaching the mark of 3,000.
So in terms of demand for zinc that would drive prices, what may some of those reasons be?
So one of them, of course, being LME sanction of Russia. On the other hand, also we see a lot of positivity in the economy, especially in US, partly in Europe, and of course India and Southeast Asia. India leading the pack with the highest ever growth rate of more than 8.4%. And we see that a lot of infrastructure spend in India, which would have a lot of consumption of zinc. You would appreciate that Hindustan Zinc sells most of its product, more than 60 to 70%, in India itself. So we are highly upbeat about the Indian market. At the same time, our export bases in Middle East, Southeast Asia are also going strong.
Arun, there are lots of challenges, including geopolitics, tensions, for instance, in the Middle East and the Red Sea. Might that impact your business? Might that impact, your exports?
So right now, our exports are not so much impacted because largely our export, about 80% is in Southeast Asia, very small percentage is in the Middle East. Nevertheless, looking at the geopolitical situation of last 2.5 years, they are not going to affect as much as they used to do earlier. Perhaps the world was fragmented much before these geopolitical tensions came in. So people have learned to have their own market bases nearby their own country. And that's how the whole world is surviving for last about 4 to 5 years. I'm sure that will be the way to go in the coming future as well.
Arun, it's not just about zinc, it's also about coal. What are you seeing in terms of supplies this year and perhaps in the summer?
So coal in general, of course, supply will be affected. And of course, many coal producing companies may go out of coal production because of the pressure on ESG. But we at Hindustan Zinc already we have resolved that we will buy 90% of our power from renewable power source. We already have the power purchase agreement in place. From this month onwards, the renewable power is landing at our doorstep. And in another couple of years' time, 90% of our thermal power plants will be closed and we will be dependent only on renewable power, where the power purchasing rate is fixed for next 20 years. So we'll be out of this apprehension prices.
And what assumptions are you making about coal prices in the coming quarters?
Coal prices are going to move up, but not as much. Not as much, I guess, because I don't see any dysfunction in the supply chain on the coal side.
Arun, we know that your board has perhaps driven a strategic restructuring of the company. How is that coming along?
So our strategic restructuring, the idea is in place, but of course all stakeholders have to be aligned first, and there are issues around the government's offer for sale for the stakes that they have. Both the things have to happen, so we are working out how both the things play out together.
So talk to us about where talks are right now about that divestment plan and when exactly that may happen.
So I personally went with government officers in the roadshows in Mumbai. There are a lot of intention on the part of government to get it done as quickly as possible. Perhaps they were waiting for the right situation in the market. Currently, Indian stock exchange markets are heating up. The price of Hindustan Zinc shares have moved up by about more than 60% in last 1 month. It has moved from 300 rupees a share to maybe 400 rupees a share. So this is the right time for government to disinvest, and I am sure and extremely hopeful that government will take note of the current situation and make the best use of it and get the divestment done in a matter of 3 to 4 months' time.
Arun, there are some reports suggesting that perhaps the government is against the split. Can you provide some confirmation whether that's true or not?
It's not for or against an idea. The government has certain reservations or questions around the idea. Principal reservation being that the whole idea that post-reservation, post-splitting of the company, the overall market cap will go up. We are businessmen. We understand business, and we know how to take risks in the business. We also know how the market operates. We believe that if we split the company into silver and lead zinc company, the silver company will have their own investors, which will pay the right price for the shares that they hold, while the lead zinc company will have their own set of investors who would pay the right price for the shares that they hold, and that would push up the market cap. Currently, we are sitting at about 20 billion, and we would cross anywhere 24, 25 billion if we split the company. That's our belief, and we are private businessmen. We know how to have an idea and execute it.
Arun, speaking of silver, we've seen a run-up in silver prices recently. What assumptions are you making about prices going forward?
Prices are currently around $29 a troy ounce. I think it will go up to 31, 32. Primarily being the world over, the silver productions are down, whereas the demand is up, primarily in the industrial sector, and propelled by huge focus on ESG, which is pushing up more and more solar panels being manufactured. Of course, the huge global communication industry, be it cell phones, be it other forms of communication, that is also pushing up a lot of silver consumption on the industry sector. We believe that this situation is going to continue, and silver prices will be northwards even now for at least next 2 to 3 years.
Right. So in terms of shortages for silver, do you see that persisting beyond 2024? Perhaps we'll see the same story in 25 and even longer?
Even longer, because new mines to come up and operate, it will take anywhere between 18 to 24 months. So in my calculation, even if the current silver producing mines have to expand beyond their lease boundaries, it will take another 18 to 20 months. So maybe another 2 years or so, we should see the silver prices becoming strong.
Arun, talk to us about your investment plan for the year, where you'll be putting your money. Which sectors in particular? Are you looking for new mines, for instance?
So as far as our current investments are concerned, we are investing to increase our roasting capacity by investing in a roaster so that we can produce about 1.25 million tons of metal. At the same time, we are on the drawing board for doubling our production in India from 1 million ton to 2 million ton. Maybe another 3 months down the line, we will be able to make a public announcement on the project and the outlay, capex outlay, and the timeline and all that. At the same time, we have listed and not listed. We have already incorporated a subsidiary company, in metal exploration company, which is dedicated to exploration, and it will bid for exploration blocks put up by government. Government of India has put up few tranches of critical mineral blocks where through Vedanta we have participated. We are, as Hindustan Zinc has participated in a gold mine that has been put into auction. So I see another 18 to 20 months, Hindustan Zinc will go beyond lead, zinc, silver, may foray into gold, may foray into platinum, molybdenum, lithium, and materials like that.
Arun, final question. We know that Prime Minister Narendra Modi is set to win the elections for a third term. What policies would you like to see from his government that would benefit companies like Hindustan Zinc?
So Mr. Modi's policy has always been that government has no business of being in business, and he has always encouraged private participation in business. That's how we have seen Air India is in the private hands. Airports, ports are all operated by efficient private players, and that's the right way to go. And in that count, I believe that Hindustan Zinc divestment will also happen soon, so that government also comes out of Hindustan Zinc, and Hindustan Zinc shareholders get to control the company fully.
Arun, it's been a pleasure having you on the show. Arun Misra, Hindustan Zinc. Thank you so much for your time today. Plenty more ahead. This is Bloomberg. Asian markets in the money. We're keeping a very close eye on Asian chip makers. Not a good story. Take a look at that. Red pretty much across the board. It has to do with NVIDIA expanding. It slumped to about 10%, erasing about $200 billion in value. It is the steepest plunge since the start of the pandemic in March 2020. Take a look at that. Advantis Corp currently down almost 5%. Samsung Electronics down by 2.5%. We're also keeping an eye on Korean stocks, auto stocks rallying on renewed value-up reform hope, and that gauge of 10 Korean banks jumping as much as 6%. That is the most since January 5th, 2023. Shinhan Financial up more than 6%. That is it from Bloomberg Markets Asia. Daybreak Middle East and Africa is next. This is Bloomberg.